Welcome to the Deep Dive. We're cutting through the noise of corporate earnings calls.
Oh,
Getting you straight to the stuff that matters.
that's the plan.
Today, it's Sprinklr. We're diving into their recent Q1 fiscal 26 earnings call.
Yep.
Our mission, unpack the financials, figure out where they are with this big transformation they're talking about.
Right.
See the challenges, the opportunities management sees, and basically get a feel for the road ahead based on what they said.
Exactly. We've gone through the call, pulled out the key bits. And what really comes across is a company, in flux, some good signs, definitely on profit and cash. But they're also being pretty upfront that there's significant work still needed. Let's kick off with the headline numbers for Q1.
Okay, let's do it. So, first quarter just finished. Total revenue, $205.5 million. That's up 5% year over year.
Okay.
And the core part, subscription revenue, that was $184.1 million, up 4% compared to last year.
Right. So modest growth there. But then you look at profit, non-GAAP operating income, they reported $36.7 million.
Which works out to an 18% margin, non-GAAP.
Yeah, pretty solid margin. And what they really emphasized was the free cash flow, record levels actually. $80.7 million reported.
Wow.
Or even higher, like $92.5 million if you adjust for some restructuring payouts they had.
That cash flow number really does stand out, especially next to that revenue growth. They also had non-GAAP net income per share of 0.12 cents.
And on the customer metrics front.
Net dollar expansion, or NDE, came in at 102%. So basically, existing customers spent, on average, 2% more this year.
Just keeping slightly ahead then.
Yeah. And they finished Q1 with 146 customers spending over $1 million a year. That's up 6% from last year, but interestingly, down just a bit from the previous quarter.
So putting that all together, it's not exactly a simple story, is it?
Yeah.
You see clear improvement on the operational side, that strong cash flow, the profitability. That's what they've been aiming for.
Right.
But, the fairly slow revenue growth, that slight dip in big customers, it tells you this isn't a company hitting the accelerator just yet.
And management wasn't hiding that.
Not at all. They were very direct. Called Fiscal 26 a transitional year. Said they're still a work in progress, has significant work to do. That framing right from the start is really important context here.
It sounds like they're owning the situation, not sugarcoating it.
Yeah.
Even with those profit wins, they're saying, hey, the engine needs work.
Exactly. And they laid out why. Two main pressures. First, the macro environment. Longer sales cycles, customers scrutinizing spending more. That's hitting everyone.
Sure. Standard stuff right now.
But, and this is key, management was pretty blunt that the bigger issue driving pressure, especially on renewals and customer churn, wasn't the economy. It was internal. Things like inconsistent operational execution over the last couple of years, lingering technical debt in their platform.
So they're kind of pointing the finger at themselves. And this execution issue that's directly leading to customers maybe leaving or spending less.
Precisely. If the implementation isn't smooth, if support isn't great, customers don't see the value fast enough, what they call time to value.
Right.
And that makes them more likely to cut back, that's downsell, or just leave altogether, which is logo churn. So tackling churn, all types of churn, by fixing execution, that was a huge theme, top priority for this transition year.
Okay, so if past internal problems are the main culprit, what are they actually doing about it now? What are the concrete steps?
Well, they outlined a few key things.
Yeah.
One is really strengthening those implementation processes, the post-sale support. The idea is simple. Get customers up and running faster, make sure they're successful. That builds confidence, makes them stick around, maybe even buy more later. It directly hits that time to value problem.
Makes sense. Well,
They're also rolling out something called a new business management system. Think of it like a much better internal dashboard. Gives them a clearer view across the whole business, helps spot risks, opportunities, react quicker.
okay, better visibility.
Yeah. And a big organizational change started back in February is this new sales pod structure.
The pods. Tell me about those.
It's about breaking down walls between sales, services, product teams, creating these unified units focused on specific customers or segments. The goal is to collaborate better, support the customer as one team, and get closer to the C-suite decision makers.
This sounds like a pretty fundamental shift in how they operate. How's it going so far? Any early signs?
Management seems to think it's crucial for changing the sales culture and driving better execution. They specifically talked about Project Bear Hug.
Project Bear Hug. Sounds cozy.
Yeah. It's basically an intense effort to really engage deeply with their top 500 customers, the ones bringing in about 80% of the revenue.
Okay.
They said they've already had detailed meetings with over 100 of these key accounts in just a few months, and they're seeing, quote, traction from it. The plan is to hit 500 or 600 customers with these deep dives over the next couple of quarters.
Getting close to the big fish. Is there like a training push behind all this, making sure the pods know what they're doing?
Oh, absolutely. They mentioned a robust enablement program for their internal teams and also their partners. Think tiered training, like 100-level basics up to 400-level advanced stuff, all focused on how to sell and deliver value in this new pod structure.
Okay, so pods, bear hug, training.
Hmm.
When do they actually expect all this to start moving the needle on the results?
Management's aiming for the latter part of the second half of this fiscal year. So Q3, Q4 timeframe, that's when they expect the sales team and the pod structure to really start getting some momentum.
And then accelerating from there.
That's the idea, accelerating into fiscal 27 and 28. But they were realistic, fixing deep execution issues, changing a company culture. That takes time. They mentioned like 12 to 24 months typically.
Right, it's not an overnight flip of a switch.
Definitely not. So moving away from the internal fixes for a second, let's talk product and market position.
Okay, Sprinklr bills itself as the AI native platform for unified customer experience. How did that translate into strategy?
They talked about an ambidextrous approach, kind of doing two things at once.
Okay.
One hand, they want to re-energize and grow the core business. That's things like social media management, their traditional marketing tech stack, Project Tiger Shark, they call it internally.
Right.
On the other hand, they're focused on hardening and expanding their big disruptive play. The Sprinklr service solution, that's their contact center as a service, or CCaaS offering.
So shore up the base, but also push hard on the new growth engine, CCaaS. Did they say how the core is doing?
Yeah, actually, they mentioned the pipeline for the core business is at its highest level over the past 18 months, so that's a positive sign.
Yeah.
And in the service, the CCaaS area, they're seeing big deals, like seven-figure opportunities.
And AI is the big differentiator there, right?
Yeah.
Especially for the service side.
That seems to be the message. They kept highlighting their AI capabilities, how it helps with real-time decisions. They mentioned an LLM-agnostic architecture.
Meaning they can plug in different AI models.
Exactly. Gives them flexibility. And they threw out some impressive numbers on AI containment rates in customer service, anywhere from 30% up to 80%.
Wow. 80% containment. That means AI is handling 4 out of 5 interactions sometimes.
Potentially, yeah. That's a huge efficiency driver for businesses. It's a strong proof point for their AI.
Okay, so if the CCaaS solution is winning deals and the AI story is strong, why aren't they just, flaring it on growth there? What's the holdup?
Management was pretty clear on this. Yes, it's winning, but CCaaS is mission critical.
Meaning it absolutely cannot fail.
Right. For a business, the contact center is vital. So before Sprinklr really pushes the accelerator on CCaaS growth, they need to make absolutely sure it's fully hardened, fully matured.
So making it bulletproof first.
Basically, yeah. Making implementation smoother, support rock solid, adding more enterprise features like advanced workflow management. It's about building that super reliable infrastructure needed for a core system before they chase hypergrowth, ensuring it's ready for prime time at scale.
Got it. They mentioned some customer wins on the call too, right?
Yeah.
Any interesting examples?
Yeah, big names like Calvin Klein, LG Electronics, Pepsi, and they gave a couple more detailed examples.
Oh, yeah.
Like a Fortune 500 medical tech company that ripped out a longtime legacy vendor to go with Sprinklr, and a big British retailer completely redoing their contact center with Sprinklr's platform.
So these aren't small incremental deals. They're replacing established players, unifying things.
Exactly. Unifying operations using the AI. Management actually credited the new collaborative pod structure, the bear hugging, as they put it, for helping land these complex wins.
Interesting. Okay, let's shift to the future then. What did the financial guidance look like?
All right, so for Q2, the current quarter, they're guiding total revenue between $205 and $206 million, subscription revenue between $184 and $185 million.
Which is about 4% growth year over year again.
Roughly, yeah, at the midpoint. And non-GAAP operating income, they expect between $33.5 and $34.5 million. They did point out this reflects planned investments back into the business, the go-to-market changes, R&D, AI stuff.
Okay, investing to fix and grow. What about the full year, fiscal 26?
So for the full year, they kept their subscription revenue guidance the same, $741 to $743 million. That's still about 3% growth at the midpoint.
Okay, no change there.
But interestingly, they raised their total revenue guidance by $3.5 million. Now, $825 to $827 million.
Wait, if subscription revenue is flat, where's the extra coming from?
Professional services, they're expecting a bit more revenue there, probably tied to those implementation improvements and projects we talked about.
Oh, okay. And profitability for the year.
They maintain the non-GAAP operating income guidance too, $129 to $131 million range. They also flagged about a $10 million hit to operating expenses from FX headwinds.
Ouch.
But they sounded confident they could find savings elsewhere to offset that, keep that profit target intact.
Sounds like they're determined to protect the bottom line while they make these changes. What about the balance sheet? Cash position?
That's a real strength. They ended Q1 with over $570 million in cash and marketable securities, and importantly, zero debt.
Nice. Clean balance sheet.
Very. And they also announced a new $150 million stock buyback program. Plan to complete that by June 2026. They called it a prudent use of cash.
Especially with the free cash flow they're generating. Are they still on track for the full year cash flow target?
Yep, reiterated the goal of a 15% free cash flow margin for FY26. That translates to around $125 million for the year. Q1 was a strong start towards that.
Okay. And that net dollar expansion rate, still hovering around 102%.
They expect it to stay around there, give or take a point or two, until they see what they call the bend in the business, that inflection point where the fixes start driving better growth.
Okay, let's maybe pull out some of the deeper themes from the Q&A part of the call. Anything else stand out about how management sees the path ahead?
Yeah, a few things. They added more color to the timeline for the go-to-market changes. Progress is happening, but that full momentum, the real acceleration, they're still pointing to late FY26. And more into FY27, FY28, really reinforces that FY26 is about laying the groundwork.
Patience is required, basically.
Seems so. They also expanded on the CX opportunity. Again, huge market, solution is winning. But that need for maturity for being mission critical means they won't rush it. It's about building it right before scaling hard.
And back to the internal versus external challenges. Do they elaborate more on how they're fixing churn specifically?
They did. Said it's a multi-pronged attack. Improving implementation consistency, aiming for like 80% standardized, repeatable processes versus bespoke ones.
Okay, systematizing it.
Right. Growing their partner ecosystem to help deliver reliably. And just more customer engagement through Project Bear Hug and the pods. But again, they were realistic. Not going to fix churn in 2 quarters. It takes time because it involves process and culture change.
You mentioned culture change earlier. That sounds like a big lift alongside everything else.
It really is. They talked about shifting the whole company culture, more customer obsession, accountability, collaboration, trust driven by these new structures. And they put that 12 to 24-month time frame on culture change.
That context is crucial. The expected bend in performance seems tied to this longer transformation taking root.
Exactly. And related to that, they said any headcount increases this year will be careful. Maybe adding 100 or so people by year end, focused on technical skills, enablement, basically waiting for the business to turn before hiring aggressively.
So it sounds like a very deliberate phased approach.
Yeah, they almost framed it like optimization phase, mostly done. Transition phase, that's FY26 fixing processes, maturing products. Then hopefully acceleration phase, FY27, FY28 onwards. Their take was essentially, we are where we should be right now in this transition.
Okay. Well, before we wrap this deep dive, it's time for our This Is Not Financial Advice segment. Remember, folks, this is purely hypothetical, illustrative, maybe entertaining, based only on what we heard in the earnings call.
Shifting tone slightly.
Right.
Hypothetical hat on. So we heard Sprinklr's got over $570 million cash, zero debt. Management explicitly said they're looking for small but meaningful acquisitions, particularly in that core Project Tiger Shark area, maybe customer feedback management. Plus, they just authorized a $150 million buyback, aiming to finish it by June 2026. And they're talking up this performance bend coming in the second half, accelerating into next year.
Okay, based only on those ingredients from the call, what's an outrageous but plausible hypothetical trade?
All right, considering that cash pile, the M&A intent for the core, that fairly aggressive buyback timeline relative to their size, and management's conviction about an inflection, a highly leveraged and speculative hypothetical play could be buying out-of-the-money call options on Sprinklr stock.
Call options. Betting the price goes up. When would they expire?
You'd probably look out to early fiscal 27, say July 2026, maybe October 2026 expirations.
And the logic. Why that's specific speculative bet?
Well, the bet isn't just that they nail the organic turnaround exactly on time. It's a bet on a potential catalyst event driven by the balance sheet and strategy they laid out in the call.
Okay, like what kind of catalyst?
Either they make a smart, value-adding acquisition in that core tiger shark space that gets investors excited and re-rates that part of the business, or maybe if they execute this transition well and have that clean balance sheet, Sprinklr itself becomes an attractive takeover target for a larger company by early next year. Either scenario could potentially push the stock much higher than just baseline organic growth expectations.
A catalyst driven by capital allocation or M&A?
Exactly. But again, purely hypothetical, high risk, based only on connecting those specific dots mentioned in the earnings call transcript.
Absolutely. And let's hammer this home.
Yeah.
This segment was purely for illustration, drawing only from the call content. It is absolutely not financial advice.
Crystal clear.
Okay, so wrapping up our deep dive on Sprinklr's Q1 FY26 call, the big picture. A company deep in a self-acknowledged transition. They're facing down significant internal execution challenges, tackling churn with clear plans like Project Bear Hug, the pod structure, and focusing on getting their products, especially CXMs, fully mature.
And they have the financial muscle to do it, strong cash flow, that hefty cash balance, the buyback plan. FY26 is the year for fixing the foundation, with the expectation or hope that this leads to that bend in performance later this year and sets them up for more predictable, solid growth in FY27 and beyond. But it's definitely not presented as a quick fix.
No, it really underscores how complex these enterprise software turnarounds can be, especially when juggling internal fixes and external pressures. I think for you, the listener, the big question coming out of this call is this. How much of Sprinklr's current headwinds are genuinely fixable through the internal execution and culture changes management is driving?
Right.
And maybe more importantly, when will that hard work realistically show up in consistently accelerating top-line growth, moving beyond just the financial discipline they've already demonstrated this quarter?
That's the multi-million-dollar question, isn't it? The next few quarters should start to shed more light on that.
Indeed. Well, thank you for joining us for this deep dive into the Sprinklr earnings call. We hope breaking it down this way gave you the key insights without having to wade through the whole thing.
Always good to unpack these calls.
And one last time, this discussion was for informational purposes only and is definitely not financial advice.